Whew. That's right, I returned to work today. First day of returning to work after the wisdom tooth removal. It went fine, but needless to say, I'm a little bit late to the party here talking about JD.com's earnings, okay? Just a little bit late to the party. But as you see, as a result of their earnings that they released this morning, they were up nearly 4% in the normal trading session. Not much movement in after-hours trading. Nothing significant there. Just kind of flowed with the market. So let's take a look at these earnings, because this is one that I was very much anticipating. I was super excited about what these earnings might hold. Really, because it's pretty crazy. You expected some big stuff out of this company, and guess what? They delivered. Non-GAAP EPS of 28 cents, beat by 19 cents, and a GAAP EPS of 10 cents, beat by 14 cents. So they were actually not expected to have a profitable quarter in terms of a GAAP standpoint. Which for me, that's just in general profitability. It's got to be on a GAAP standpoint, but some people disagree. But I prefer the GAAP number typically. But that's what I would call crazy. So that is a very, very good quarter. Needless to say, I mean, that goes without saying. Just on an EPS standpoint, very nice. Then you take into account the revenue aspect of it. $20.6 billion, up 20.7% year over year, beat by $1.3 billion. Now that is a massive beat too. Just a massive beat on both aspects. And it's something you kind of anticipated. You feel like they would have raised guidance, but you kind of anticipate it just due to or raised estimates, I should say. They were in just prime situation for this demand. So the JD.com is really a Chinese online retailer. And they were, this position, or this quarter was poised for the biggest success for them because they were shut down most of the time during this quarter. So JD.com was the place to go. I think the question becomes, what does it look like after this? Does the momentum stay for them? I don't know, but it'll be interesting to find out for sure. Annual active customers increased 25% to 387.4 on a trailing 12-month basis. Mobile monthly daily active users in March increased 46% year over year. Massive stuff. Adjusted EBITDA of $637.5 million and a margin of 3.1%. That seems very low from a margin perspective. So you see those numbers, and to me it's almost slightly shocking the stock only went up 4%, right? You see a beat like that, and as a company trading at an earnings right now, forward earnings of 38, when there's a lot of other companies that are trading at very steeper in terms of forward EPS. It actually should be lower now that they posted such a good number, and their guidance was a little bit higher. So it should be actually a better number in terms of that forward EPS number. So you kind of would expect it to trade at a little bit higher of a multiple at this point, because really there's kind of two markets right now. There's those bogged down by the pandemic, and then there's those that are thriving from it. And those that are thriving from it are in a full-on bull market. So it's just interesting to see. I don't know. I expected it to go up a little bit more, I would guess. But let's get into some of these fine details too. Net income declined on the quarter, falling from 70 cents to 10 cents. So that might be where you see a little bit of the issue there. You see a little bit of a loss in profitability. And it's not unexpected, because really every company right now is taking a massive profit hit. Regardless if they're getting mega revenue or not, they're taking massive profit hits. So it's kind of something you expected to see. So fulfillment expenses were up 29%, which doesn't shock me at all, because of the fact that, well, they had to fulfill a lot more orders. For quarter two, JDC's revenue of 180 to 195 billion, which is, again, this is an RMB, just so you know. This is going to be in yen, I think, versus the consensus of 176.5 billion. So a massive beat in terms of estimates for sure. Massive beat there. Let's take a look at these slides that they posted. Obviously, they say they show robust growth. As you see, 9.8% average growth rate from 2012 to 2019. Pretty big. And China just keep keeps growing big. So top 20 retailers market concentrated in 2019. You see in China, they're only making 18% of the whole retail market. So definitely when you think about the opportunity that they have, it's pretty massive. Right now they've penetrated 23.6% by this quarter is what they're showing. Really a lot more penetration to happen, and I hate saying penetration so much, but I said it. And they're expecting a 10% annualized growth rate from 2020 to 2023 as far as what they're expecting. So pretty big. Very big. So the top 10 listed retailers in China, you see JD.com, number one, baby. Number one by a good margin. As far as net revenues are concerned, definitely big. So, in the top 10 retailers in the U.S., here they kind of compare them to right around where Amazon's at. Because that's in terms of annualized growth rate, that's kind of where they're looking. They're near the exact same number there. So, interesting numbers there for sure. Obviously, Walmart being the champion. So strong growth momentum. So you're expecting net revenues to grow 21% year over year, or they did grow 21% year over year. Pretty big in that aspect. So from a breakdown perspective, just good stuff going on here from net service revenue and product revenue, both growing pretty big. From a products perspective, you see general merchandise was up 38%, and electronics and home appliances up 10%, so that's very nice as well. And marketplace and advertising services grew 17%, and the logistics and other services grew 54%. Pretty nice. So profitability is improving with scale is what they're going to mention here. So these lines are going to be the gross margin. They're expecting that to just continue being nice. Continued growth in terms of margin would be interesting if they could pull that off. And net margin, they're expecting to stay pretty consistent as well. So definitely interesting to look at that. Robust cash flow is what they're talking about. They're generating cash pretty heavily. We'll look at their balance sheet for sure with this and take a look at what we have going on here. Here's a good chart for annual active customers. You see the growth from first quarter 2019 up until the first quarter of this year. Pretty massive growth there. And obviously you see free cash flow has been showing some improvement as well. So they're working on distribution centers. They have distribution centers in 29 cities, fulfillment centers in 7 cities, warehouses. They have 730 plus warehouses. Pretty nice stuff. So almost all countries and districts in China are covered by some JD area. So that's obviously what they give for us in terms of slides. The only other thing we look at here is going to be you got to give me just 1 second here to look at this lovely balance sheet, and then once we look at this balance sheet, we'll say what we think about this company. Okay. Let's just take a little darn look. There's your lovely slides, as you saw. Those aren't the slides I want, you darn stinkers. You darn stinkers. So this is what I want, and we will definitely enjoy this. That's exactly what I wanted. How'd they know? Let's see. There it is. Oh, they try to hide it from me. So as far as current assets are concerned, we're going to be looking on the far right, I guess, if you want to, because this is the U.S. dollars total. That's what I care more about personally, because we speak about the U.S. dollars personally. They've got $20.4 billion in total current assets, and total assets in general of $37 billion. Pretty massive, all things considered. From a liabilities perspective, they have a total current liabilities of $19.2 billion, which is right in line with their assets, their current assets, which is definitely something to probably consider. And their total liabilities in general of $22.9 billion. So they still have a shareholder equity there of around $13.5 billion, or $14.5 billion, I should say. So they do have a good bit more cash than they do in terms of liabilities, and if debt's an issue, it shouldn't be an issue because they're generating the cash flow to really eliminate that issue. So I don't know. I really like what this company's doing. I would have bet it would have gone up a little bit more. So kind of a shocker it didn't. Um, yeah, I don't know. I think it's a decent stock for especially even post-pandemic just momentum. I think they'll be doing well. So decent stock here for sure. I'm interested and I will keep looking at it.